Welcome to our video on understanding bond ladder investing, a comprehensive guide. A bond ladder is an investment strategy involving the purchase of multiple bonds with increasingly longer maturity dates as the ladder extends to a specific future date. You can create a 5-year ladder, a 10-year ladder, or a ladder that is shorter or longer. This strategy achieves two objectives. First, it provides investors with a steady stream of income. Second, it mitigates the impact of interest rate fluctuations, aka interest rate risk. This presentation is brought to you by Higgins Capital, where planning for your future is our priority. Before we continue, please take a moment to subscribe to our channel. At Higgins Capital, we bring you original content that you won't find elsewhere. Subscribe and be notified when we post. Thanks, and now on with the video. Bond ladders provide investors with a strategic approach to fixed income investing, offering a steady income stream, reduced interest rate risk, and increased flexibility. By diversifying across multiple bonds with staggered maturity dates, investors can navigate the challenges posed by fluctuating interest rates and achieve their long-term financial goals. Imagine a ladder, but instead of rungs, you have bonds. Each bond represents a step on this ladder, each with a different maturity date. This is the basis of bond ladder investing, and as we've mentioned, a ladder is a strategic approach to fixed income investing that offers three key advantages. First, it provides a steady stream of income as each bond matures. Second, it reduces the risk associated with fluctuating interest rates, also known as interest rate risk. Lastly, it offers increased flexibility, allowing you to adapt your investment strategy based on your financial goals and market conditions. In essence, bond ladder investing is about diversification, strategy, and financial foresight. Now that we've understood the basic concept, let's delve deeper to understand how it works. So, how does bond ladder investing work? Let's break it down. Picture a ladder. Each rung represents a different bond with its own unique maturity date. By diversifying across multiple bonds with staggered maturity dates, investors can navigate the choppy waters of fluctuating interest rates and set sail to their long-term financial goals. This strategy achieves two key objectives. First, it provides a steady stream of income. Each time a bond matures, it's like a rung on the ladder being reached. The investor receives the principal back, ready to be reinvested or used as they see fit. This creates a regular inflow of cash, providing a sense of financial stability and predictability. Second, a bond ladder mitigates the impact of interest rate fluctuations, sometimes referred to as interest rate risk. Interest rates and bond prices have an inverse relationship. When rates rise, bond prices fall, and vice versa. However, by investing in bonds that mature at regular intervals, investors can reinvest the proceeds from maturing bonds into new ones. This allows them to potentially benefit from higher interest rates, thereby reducing the negative impact of interest rate movements on their overall portfolio. Now, let's paint a picture with an example. An investor might purchase bonds maturing in 1, 3, 5, 7, and 10 years, thereby creating a 10-year bond ladder. Each year, as a bond matures, the investor can choose to reinvest the proceeds into a new 10-year bond. This keeps the ladder intact, extending the investment horizon and maintaining a consistent cash flow. Moreover, bond ladders offer flexibility. Investors can adjust their ladder based on their financial goals and market conditions. They can add or remove rungs or adjust the length of the ladder as needed, providing a tailor-made investment strategy. As we can see, the bond ladder strategy provides a predictable return on investment and a consistent cash flow. It's like having your financial future on a well-structured, sturdy ladder, each rung a step closer to your long-term goals. Having understood the workings, let's now look at the benefits and flexibility that bond ladder investing offers. This strategy is not a one-size-fits-all. It is versatile, allowing you to adjust your ladder based on your financial goals and market conditions. This means you can tailor your investment ladder to suit your individual needs, whether you're aiming for retirement, a large purchase, or simply to grow your wealth. The primary advantage of a bond ladder is its ability to benefit from both short-term and long-term interest rates. Picture this. You've got a 10-step ladder. Each step represents a bond with a different maturity date. Now imagine one of your bonds, the third step on your ladder, reaches its maturity date. You've just received a payout, but rather than spending it, you decide to reinvest it. Here's where the flexibility comes in. You can choose to reinvest at the long end of the ladder, say the 10th step, potentially taking advantage of higher interest rates. This process of reinvesting maintains the ladder's structure and offers you a steady stream of income from the regular maturity of bonds. But what if the interest rates are not in your favor? What if they're lower than when you first invested? Not to worry, because you have bonds maturing at different times, you're not locked into one rate for the long haul. This staggered approach allows you to weather the storm of fluctuating interest rates, reducing the overall impact on your investment. In short, a bond ladder is like a well-rounded diet for your portfolio. It provides a steady income stream, reduces interest rate risk, and offers the flexibility to adjust as per market conditions and personal goals. It's a strategy that enables you to take a more active role in your investments, making decisions based on your financial objectives rather than being at the mercy of the market. With its strategic approach, bond ladder investing serves as a powerful tool to navigate fluctuating interest rates and achieve long-term financial goals. To sum up, bond ladder investing provides a strategic approach to fixed income investing. It offers a steady income stream, reduces interest rate risk, and increases flexibility. By purchasing multiple bonds with staggered maturity dates, you can navigate the challenges of fluctuating interest rates and aim for your long-term financial goals. This approach allows for a consistent cash flow and a more predictable return on investment. Thank you for joining us today. We hope this guide helps you in understanding and implementing bond ladder investing effectively. At Higgins Capital, we are experts at creating bond ladders for our clients. Let us hear from you.